All right, lesson 3. Let's see what we're going to talk about today. We're going to look at moving averages. So now we had talked about in the previous videos about the what MACD is, the histogram, um, the short and long term view, and how I find a, a potential setup using the MACD, the short and long term, but mainly the short. Now I want to kind of combine another aspect or indicator that I have on my charts that a lot that gives me a little bit more confirmation. And as I build, and as these videos, each should build upon another, and at some point it'll have a complete picture as to uh, how I trade and what I look for and how I get into it and how I enter, how I exit, that kind of thing. But now we're going to look at the moving averages. It's really pretty straightforward. Um, I've been toying with these moving averages for quite some time. I've used simple, linear, um, whole, different kinds, but I kind of settled on exponential. It gives a little bit more of it tracks price just a little bit more, and it's a little bit more sensitive than the simple moving average. So the one that I use, or the moving averages that I use, I have a what they call a ribbon, and I got this philosophy and idea from uh, what's the guy's name? He has like the fast ribbon and the Guppy, Daryl Guppy. That's where I got it from. I like it. It makes me feel calm when I see it. He gives a fast, depending on if you're going to be day trading, he gives a fast and a long term, or short term and a long term uh, aspect of where you want to get in, how to take profits. So I kind of adopt that philosophy from him. And he's really big into, I followed him, Jesse Livermore, anybody who were trend traders back in the day, and that's who I've modeled most of my philosophies and ideas about how to earn profit in the markets, because I'm more of an investor than I am a day trader. That I understand about myself. I prefer to have my money working for me as opposed to me getting in here grinding it out every day. If I wanted to do that, I could just stop doing this and keep working my job. So I usually take 1 to 2 trades within a session. Really, I'll just take one. But if I, for whatever reason, lose a trade, then I'll hang out and stay and see if I can make up for and see if I can find another setup that will allow me to make up for what I've lost on the first trade up until my session's over. Otherwise, I just have to kind of take a loss for that day and come back to the next day to see um, what I could do and chalk it up as a lost day and come back and do it again. So, so that just kind of paints a picture as to how and why I like trend trading. It's a little bit calmer as opposed to just kind of trading everything. Like I said, I do. It's at sometimes if I were to put a percentage on it, I'd say maybe 90% of the time I'm trend trading. The other time I'm probably taking a bounce off of a range or and taking taking profit in there or a loss within that. But mainly I trend trade. So with that being said, what you see on the screen, you don't really need the ribbon. I've found indicators that kind of quickly paints a picture as to what I want to look for. So when I walk into my office, I want to see. Let me cut this. Well, I guess the fan I think is fine. Hopefully it's not drowning out any noise. Um, so I look at the 50, and I also have a 292 exponential moving average. If you can see on my charts, it's the EMA. The smallest one is the 50, and the largest one is 292. Now within that, I and it gives this ribbon, and really this is actually a ribbon indicator that, let me see if I can, I'll open it back up. And what it does is essentially it paints, once the 50 and the 292 flip, it makes everything green. And if it's falling, then it makes it maroon or red. So just from a visual standpoint, it's just a little bit more appealing to me. It's really just an aesthetics kind of thing, but you don't really need to have it. You only really need to have the 50 and the 292, which is just essentially two exponential moving averages. You don't need to have all the other stuff on there. For me, it just kind of works for me. And with that, when it flips and when it changes, it gives these lines that says, okay, we have now flipped to go short, or we have flipped to go long. So I usually wait for everything to flip to say, okay, we're in a uptrend or a downtrend before, and that way it gives me an indication from a moving average standpoint of which direction I should be looking for trades. So because we're just looking at moving averages, we are going to just look at the moving average, and then we're going to add in the MACDs. Okay. Well, we kind of touched on it a little bit, or I kind of touched on a little bit about how and what I look for once everything happens. And I can go back in time, and I think I will. I'll find another. And I like it. I'm very comfortable trading long. I've gotten accustomed to looking at things and buying things as opposed to selling them. I get a little anxiety when I do sell. I do it because the setup tells me I should do it, but for whatever reason, um, I'm I'm really comfortable buying the market than I am selling it. And I have a friend that I trade with sometimes, and he's the opposite. He loves shorting the market. He loves shorting it, and he gets a joy out of it. I get uncomfortable, and we work in opposites. Like I love buying the market. He can't stand it. He can't visually see for whatever reason. Your mind kind of plays tricks on you, and you get comfortable doing one thing. So I'm comfortable trading, really, really comfortable buying the market, but I will short and sell the market off if it tells me to. Okay. So the moving averages, once the moving average cross, this is an example here. Once the 50 crosses the, let me see, I may actually what I'll do so you can kind of see, take this off and just let me open up another chart. Let me just actually just take, let me just delete this whole thing off. I got a lot of other charts. See. See if we can get it. Oh well. For the lack of for the trying to keep the video short. So this line at the very top is the 50. See it here? And then the one on the bottom is the 292. So once everything flips over, which is this right here, this tells me, okay, I should be looking only for longs. I want to buy the market. Doesn't matter if ideally you want to buy during the New York session because it's a little bit more volatile and you can get in and get out of your positions quickly. No, but wherever the setup happens is where it sets up. So once it crosses, the 50 crosses up, then we want to wait. We just want to sit on our hands and just keep in mind this 108 tick chart is a 2-minute time frame in a time-based chart. So there's no need to rush, no need to feel like you're missing something. So wait for it. The criteria for me is to wait for it to get to the moving average. It has to touch the moving average. That is one of the criteria. Wait until it touches the moving average, which is, it touches it right there. So once it crossed here, we don't do anything for almost, and this, let's say at 12 o'clock, we waited until, I don't even know what that is. It's 5, 7 o'clock in the morning. It was chugging a little slow. We wouldn't have done anything all in here, because the space that's between where this price is versus where the moving average is, there is a likelihood it's what is called mean reversion. This is kind of extra stuff that you really don't need to know, but just kind of painting context as to why price does what it does and why moving averages do what they do. The moving averages always act as support, resistance, magnets. So when you have that much space in between moving averages, depending on which one you decide to put on your chart, that space in between, just understand that price wants to come back to those moving average. It doesn't matter what moving average you put on your chart. Price will want to touch and go back to it. So you want to wait for price to do that. So I have the 50 and the 292 on my charts, and I may, depending on how things go, I may adjust it down to 200. But right now, this has been working for me, because sometimes price goes in really, really deep, and then we'll get into when it goes in deeply. How do I react to that, and do I want to trade it? Ideally, I want it to touch the 50 moving average, and then I want to look at, let's see, where are we? So I'm trying to blow it up so you can kind of see. So once it touches the moving average, okay, what do I want to do now? Now that I know that the 50 has crossed the 292, I know that means, oh, I want to be looking for longs. So I'm sitting on my hands. I'm just like, okay, I'm just going to sit here and I'm just going to wait. I'm just going to wait. There's too much space in between that. I have to wait for the mean reversion, or to revert back to the mean. My mean is the 50 moving average. So once it gets to the 50 moving average, exponential moving average, I then go down to the MACD. I look at the fast MACD, the 720 and 30, and say, okay, what is it doing? In the other videos, okay, oh, the quick MACD, let's see if I can, from here to here, oh, it's negative. That's what I want. I want everything to be below zero, because we want a nice pullback. And then also we want the moving averages, and it revert it back to the mean, and it's negative. So now we have these certain criteria that we're slowly starting to paint. So let me review. The 50 and the 292 has crossed to the upside. We have now waited, and now it has, number 2, touched the 50 moving as a minimum. It has to touch, bounce, do something, but it just can't be out in outer space. It has to touch it. That's at bare minimum, it has to touch. We then look down to the quick moving average and see if it dropped below zero. And did it drop below zero? Yes. So all the histogram, the MACD histogram, it's below zero. And now we wait. And then we just wait for it to turn. Okay. It's as simple as that. So I'm not going to keep the video going too long, because now I'm slowly, like I said, I'm building a case to take a trade. So far, let me recap and review. We waited for the 50 to cross up. We waited for the 50 and 292 to cross. Now we waited for it to pull back and make sure that the quick MACD is negative. Now, just as a side note, and I'm sure you're looking at it as well, the larger MACD has crossed and went below zero. That's even better. So that gives us an idea that it gives us a better idea that, okay, now we have to keep in mind that when the pullback happens, there's a likelihood off of that bounce that we may get a deeper correction. It may pull back deeper. So once it bounces off and you see those green candles here, let me blow it up so you can see it. So at first shot, oh, it bounced off. Everything's negative. It turned green. Let me get in. Nope. Looking at the larger MACD, there's a likelihood that we're going to keep going further down, because remember, the longer term gives you a longer term view of it going down. So we want to take that into account as well, that this may be just a fake out. And again, sometimes I get, when I get a signal, I may take it and I may lose, but that's just part of it. But just understand that if it keeps going down, we want to then start shifting our mindset to say, okay, even though I may have lost out on that first trade, let's see if it goes deeper, and then let me try it again, and then let me try it. So just as a, okay. Oh, let me go ahead and add this. I was going to wait for another video. So when it does go deeper and I lose a trade, I add a trend line to the top of the peaks. Well, I just add it to the tops, and then I draw a line, and then I wait. I don't take the break of the trend line. Like I said, I use the Hikinashi to get in. This is just another confirmation for another part of the case that we're trying to build to see if we want to take the trade. So, but by and large, we want to take the trade by our histogram, and also I'll add in the Hikinashi candles and figure out when the Hikinashi signal happens. All right, so hopefully that kind of paints a picture on the moving average and how I look at it, and also the trend line once it goes deeper into it. So just a final recap. If the 50 crosses above the 292, we wait for longs. We don't get in immediately. We wait for the correction, the corrective move, or what they call a retracement or pullback. It has to touch the 50 at a bare minimum. If it doesn't, you do nothing. You wait until it does. When it does, you look at the histogram, the fast one, to see if it's below zero. And if not, then you wait. I like to get in, like I said, at the best price as I can, and then go from there. And then you wait for, if it drops deeper, wait for it to either break the trend line or wait for the Hikinashi signal. We'll get more into that down the line, but hopefully you're taking notes as to building a case to take a trade, and how I, in my mind, build a case in my head for what I'm looking for and what criteria I have to get in to take a trade. All right, and you can do this on the opposite side as well. We had all of this selling off movement here. You cross here. This is actually the cross going down. Now we don't do anything. We just hang tight and wait for it to get back to the moving average, the 50, which it ended up touching here. We didn't do anything here. We just let it. We wanted to bounce and do some good stuff. And I'll also start adding this kind of stuff in. But again, that's for another video. but that's what I look at. So it touches the 50. Is it above? Is the fast MACD above the zero line? Yes, it is. It's right here. And then what happens? Then it turns. At In this case, I didn't have to draw a trend line. It immediately turned. But once you start getting into higher highs and higher lows in a downtrend, which, let's say for instance, we didn't get anything and then we finally got this. That's when you use the trend line. Now, because you're now creating higher highs and higher lows, but we want to go down. So we want to wait for it to turn. And that's what I use as an indication. See, and then if you can even look down here, it's above, and we just keep going. And then once I would have gotten in here, and then it would have broke down and went below, but we're already in the trade. And then pretty soon I'll show you how to get out of it. But just building a case, make sure you take notes. And then when this is done, I want you to, after all this stuff is done, if you want to try it, cool. And if it works for you, just post it in the comments to say, hey, so far this is working. And that's pretty much it. But I think I'm not exactly sure if it's going to be a 5-video series. Who knows? Once I get everything in the point across of what I'm trying to deliver, then I'm not going to keep reposting. I'm just going to start trading. I'll start continuously post live trades. But I just want to at least get a little video series out there just to say, okay, well, what the heck are you doing and why are you doing it? So this is kind of what the picture I'm trying to paint. And then if you want to follow along, just use the method and do what you do. Okay. All right. I am out of here. And this is essentially like combining the moving averages with the MACD to determine the trend confirmation. All right. Later.